Hi guys, my name is Franklin, founder of Halogen FX. Super excited to bring you back to this new video, which will be about liquidity. So guys, if you like all this series I'm doing, the series of smart money concept strategy I'm doing, please don't forget to subscribe to my channel, like and turn on post notification in order for YouTube to recommend this video. Sorry about that. To those that want to really learn about the smart money concept. Without wasting much of your time, I'm going to let the intro roll in. Before I do that, please, I am not a financial advisor. I am just here to do to share my trading ideas and knowledge based on the smart money concept. So guys, I'm going to let the intro roll in. See you in the next slide. Welcome back, traders. Like I said, in today's video we'll be talking about liquidity, what are liquidity, how to identify them very properly. Now, like I said, what are liquidity are money in the financial market. Definitely money. Which people create this liquidity? The banks, the institution, that the one that can only do create liquidity in the financial market. How do we spot liquidity? Let me take you guys there. Now, in a trending market, definitely in a downtrend market, the market is actually making lower lows and lower highs. Now, I want us to sit down and understand this very, very well. This is a downtrend. The market is actually moving in a downtrend now, making lower lows and lower highs. Now, in the retail perspective, we're told that when you see the market making this kind of a move, you need to draw out a trend line that will touch the two best fitting line, and you can see the two best fitting line. Now when you draw out this trend line, we're told that we should sell at the third touch of the trend line. Definitely when you're selling from the third touch of the trend line, where these retail traders place their money is above this trend line. All their stop losses, the stop losses are known as the money, because this is the amount of the amount you want to risk. And mind you, we have a lot of retail traders in this world, billions, and most of them might be willing to do to sell from the third touch of the resistance. Definitely all their stop loss are placed above this trend line. Now when this institution comes into the market and I want to trade the market, what they first of all do is to take out these retail traders before they can make any move to the downside or to the upside. Now how do these retail traders, rather the institution, do it? Is, mind you, the retail traders, all their stop loss are above there, which looks like something like this. They place their stop loss above the trend line in order for them to continue the trend downward. But when the institution wants to make their move, what they first of all do is to take out those retail traders that are willing to sell from this trend line, leaving their stop loss above the trend line. So the institution will first of all take them out in order for them to make the move downwards. Take the minus for make the move downwards massively. And when this retail trader has been stopped out, if you check the next move that follows, the next move is very, very massive. That shows that it is the only institution that can make that move, not you and I that are retail traders. I don't trade the retail perspective. I was once doing that. I am not saying that retail trading perspective isn't profitable. It is, but when you are trading the smart money concept, you should know all these key points, because that is what keeps you or gives you an edge in the financial market. And when they have been taken out, when the sellers have been taken out, mind you, there are some retail traders that want to sell, that trade the break and retail strategy. They want to continue the selling trend. Rather, they want to continue to sell the market since the market is already in a downtrend. They will place their order here. Those trading the break and retail strategy, they will place an order here, leaving their stop loss above that previous support that was taken out. Now when the institution are not done with the market, they're not done with the movement, what they do, mind you, then based on the previous video I posted on that block, the institution will come back and bring price back to the order block that led to that massive move. And mind you, when they bring back price back to that order block, all these retail traders that are said they're trying to sell here, they are also being taken out in order for the banks to do to continue the trend downwards. This is the first case study of liquidity. If you're able to identify this as a smart money concept trader, you're going to have edge in the financial market. The second scenario is the same thing is applicable to the uptrend market, when the market is making higher highs and higher lows. Higher highs and higher lows. Definitely the trend line are being drawn. Sorry, don't mind my drawing, I'm not so good in drawing, you understand? So the trend line, they are willing to do what the retail traders are willing to buy from the third touch of the trend line. Definitely their orders, their stop loss will be placed below the trend line in order for them to continue the buy trend. But when the banks want to make move, they'll first of all do take those retail traders out, take them out before they can make that massive move. And definitely, like there are some retail traders that are willing to do to buy the break and retest to continue the trend up. And what they do, smart money, the banks, I don't know why I keep saying smart money, what the banks do is to bring price back to that order block in order for them to continue their uptrend. Now the case 2 study for this liquidity is this double top. Double top is also a sign for us as a smart money concept where liquidity lies. Based on the retail traders perspective, they were told that whenever they see this pattern, double top or M pattern, that what you are supposed to do is to sell from the third touch of that M pattern. And mind you, when you are selling from the third touch, this whole place is the resistance. This whole place is is the resistance. If you want to sell, you're selling from the resistance. Now they are putting their stop loss above that resistance. And mind you, the stop loss are money, billions of money in the market by the retail trader. What the banks do is to take out these billions of money first before they can make any move either to the upside or to the downside. Now the retail trader perspective is willing to sell from the third touch of this double bottom in order for it to go down. But mind you, when the banks want to make move, what do? They stop them out. When they are being stopped out, there are other retail traders with another perspective that trade the breakout strategy. The breakout strategy. How they trade this is whenever they see they break out from a resistance, they have that perspective that the market will continue upwards. So definitely their orders are placed here, keeping their stop loss below that resistance. Mind you, the banks are not done with the movement. When they take out the sell side retail traders, what do they do now? They take out those buy side retail traders that want to continue the trend up. They take them out to stop them out and prove price downwards. They are not yet done. There are also retail traders that want to do sell the breakout. They want to sell the breakout from this support. They want to sell the breakout. Now definitely their orders are being placed here. They place their order here in order for them to do to continue the selling pressure. And what will smart money the banks do? What do? They bring price back to that order block that made that impulse move. And mind you, when they bring price back to that order block, all these retail traders are willing to sell the breakout in order for price to continue downward are being stopped out before the bank can now continue their move to the downside. This is the second case study of liquidity. Now the third case study of liquidity is the same thing is applicable to the support. The same thing, double bottom. In this case, it's called double bottom. When you see it, this is just like the W pattern. They are willing to do these retail traders are willing to do buy from the support below. Definitely their orders have been placed here. They place their order at the third, not for the third touch to occur. They place their order there, putting their stop loss below the support. And mind you, when their stop loss are here, they are not the only way. We don't have one retail trader in the world, we have billions of them. So their stop loss line below there, which is the money, which is known as the liquidity. When the banks want to make any move, they first of all stop them out, take all their money, and take those people that want to do what, that want to buy, that want to sell the breakout from the support, and take them out too. When they take them out, then the banks make this move, and bring price back to that other block in order for them to continue the trend upwards. I think my chart is not messy, sorry about that. So I just hope you get this thing, understand. It's gonna be easy, but when you go over this video all over, you get the point. It's just for you to know this concept, and when you apply it in your trading, you have an edge in the financial market. So guys, the third case study of here is in the in a consolidating market, like these two I just mentioned. This, yeah, the two examples, the three examples I just explained are on a trending market. But now we have the consolidating market, where the buyers and the sellers are at equilibrium. Now for those retail traders that trade the ranging market or the consolidating market, now definitely how they trade is they sell from the resistance and buy from the support. So now you should have it in mind that lot of money is above this resistance. Lot and billions of money is above this resistance, because these retail traders are placing their stop loss above resistance, because they are willing to sell from resistance and buy from support. So definitely the same thing is applicable to the support here. A lot of money is below the support. Now when the banks come into the market and want to make move either to the upside or to the downside, what do? Like I've explained before, they take out these retail traders first. When they're being taken out, in order for them to make their move either to the upside or to the downside. How do they do this in this kind of a scenario, in this case study? What they do is first is to take those retail traders that are willing to to sell from that resistance. They are willing to sell from that resistance. They take them out, and also take those retail traders that want to buy the breakout of that from that resistance. They take them out too. How am I bringing this? There are those that they are willing to they take them out too. Their stop loss is below the their stop loss is below the resistance. They take them out too. After taking them out, they bring price back down. And mind you, there are also retail traders that are also willing to buy from this support. What do the institution do? Is to also take them out too. Now when the institution are taking these retail traders out, those that are willing to buy from here, their stop loss are below here. When the institution have taken them out, and also another retail trader also want to sell the breakout, what do the banks do? Also, they take them out too. Take those that are willing to buy, rather to sell the breakout. They are willing to sell the breakout from here. Messy, a lot of position. This is just for explanation, for you to get it. I'll clear my chart very soon. So they take them out too, and what the banks do, they bring back price to that other block that led to that movement. When you see this thing to continue the trend down, when you see this thing, you should know that the banks has made a move in this region. Sharp intro into this thing again. First, how to identify liquidity. When you how to identify liquidity. First, when liquidity is being taken out, the movement is very, very, very massive. Another word, impulse. It leaves behind imbalance behind, rather. It leaves imbalance behind, also, and also leaves another block behind. When you know these 3 points, you're good to go as a smart money trader. So guys, I'll take you over to the chart to give you this explanation in the chart, from where you'll be seeing them all live at right front of you. So this is just the diagrammatic representation of everything I'll be showing in the chart. It doesn't look this so clean, but I'm going to give you guys the ones that are the examples I've marked out that are a bit like this. You get the point. So guys, let's go to the chart. I think I've marked them. Yeah, this is the case. This one, this place I marked. Okay, yeah, this box. Watch, let me delete it now. Like you can see, this market is making what? Lower lows and what? Lower highs in the trending market. The market is making lower lows and what? Lower highs. This is downtrend. You can agree to me. This is downtrend, making lower lows and lower highs. Now, drawing this trend line, I've drawn my trend line already based on the retail perspective. Drawing this trend line, it has a two touches, 1 and 2. Now, definitely, retail traders are willing to do what? To sell from the what? The third touch. They're willing to do what? To sell from the third touch here, putting their stop loss above the what? The resistance, the trend line. And you can see it, putting their stop loss above here. Let me hide it here. So I know. Okay, guys, you've seen it already. You've seen it. So putting their stop loss above what? The resistance. Now you can see what the market do. What the market did rather. You can see what happened here. Now they have been stopped out here. They stopped them. The institutions stopped them out, and also stopped those that are willing to do what? To buy from this support. Those that are willing to buy from this support. Those that are willing to do what? To buy from this support, and also do what? Sell the breakout. Just watch very well. They are retail traders are willing to do what? To buy from this support. Sorry, the retail traders are willing to do what? What am I doing? Am I bringing this one? This is buy. Okay, the retail traders they are what? They are willing to do what? To buy from this support, and definitely their stop loss is below the what? That support. And you can see the banks. See what happened? They did what? They stopped them out with this weak candle. They stopped them out. Let me permit me to delete this so you don't get messy. They stopped them out with this weak candle. You understand? And definitely there are also retail traders that are willing to do what? To sell the breakout from this support. The retail traders are willing to sell the breakout from this support. And you can see they are being what? Stopped out. And after those scenario, everything stopping them out. Just watch the massive movement of these candles. Look at the massive move of this candle. Look at how massive it is, and it went up. The only people that can cause this massive impulse move is the banks. After making this move, what then happened? They brought price back to this what? They brought price back to this what? Other block. This week is another block. But if you go, I'm going to explain more as we as we go on. I'm going to explain more. This week, if you go on lower time frame, you know that this week is an order block, and they brought price back to that what? Order block. And you can see, placing your order like this, and you can see what then happened. The market flew up. The market flew up to the upside. This is the case study of the number one case study. Retail traders are willing to sell from the third touch, and what happened? The banks stop them out, stop those that are willing to buy from the support, and those that are willing to sell the breakout. And what then happened? They made that massive move up to the upside, and what happened after that massive move? They bring price back to that other block that led that movement in order for them to continue the trend, and that is just what just happened. So taking over to the second case study here, I mark them out. So now this is the scenario of what? The double top, the M pattern, like the retail perspective we say. The M pattern, you can see the first touch, the second, the neck pattern, and the second touch. You can see this is just like already forming the what? The M pattern. The M pattern. So now you can accept that from this whole region I just marked is the retail trader resistance, and they are willing to to sell from this from the third touch. They're willing to do to sell from the third touch whenever the market comes back. And you can see the market came back. What did the banks do? their stop loss definitely will be placed here. What did the banks do? The bank stopped them out and made that what massive move to what, to the downside. The bank stopped them out here, stop them out and make that massive move to what, to the downside. So when you're able to spot this double top, double bottom, when you see this thing as a smart money concept trader, you should know that what, you shouldn't be trading the double top and double bottom. What you need to know about the double top and the double bottom is the what, the liquidity. When you see them, know that it's when the banks are coming into the market, definitely will take out this double top and double bottom, which is also known as what, equal lows and what, equal highs. For this case study here, it is what, equal highs. So taking you over to the third one, all over here, yes. Now this third scenario is the consolidating what example I gave to you guys. You can see the market is what is the market is actually what, ranging in this box. It is moving sideways. The buyers and the sellers are at equilibrium. You can see from here the market moved up, came down again, moved up again, came down again, just making this move, and you can see this is a consolidating what, market or ranging market. Now mind you, those retail traders are what, are selling from the what, the resistance. They are selling from the resistance and buying from the support. And mind you, when they are doing this thing, their stop loss is above what, those resistance and stop and what, and support. They are placing their stop losses above those areas based on their retail perspective. Now you as a smart money concept trader, you shouldn't be doing this. You shouldn't be trading the resistance and the what, or the support. What you should be doing is to, when you see this thing, take note that when you see this thing, they are known as what, the liquidity. Now when the banks come into the market, what do? They stop them out first. Now look at this case study. They stopped those that are willing to do, or those retail traders that are willing to do, to buy from this support. What did the banks do? What did the bank do? What they did was what? Sorry about that. What they did was, those that are willing to buy from here, what they did was what? To stop them out. You can see they stopped them out. They stopped all those retail traders that are willing to what? To buy from this support. They stopped them out. And those that are willing to do what? To sell the breakout from that support. You can see those retail traders that are willing to do, to sell those supports, placing their stop loss above this support. What then happened? The market stopped them out. And you can see this massive candle here. See this massive candle after the banks stop them out. You can see the candle here is very, very massive, which shows that this is the banks that can only do these things. They stop those that are willing to do what? Buy from the support. Stop those that are willing to do what? To sell the breakout. And after doing that, they push price to the upside. I know they didn't come back to mitigate this order block, but nothing is 100%, and you can see what happened. The market all moved to the upside. So guys, I know it's not gonna be easy, but when you take this series all over again, take it one after the other, everything will get simple and simpler. You get the point? So guys, go over this video again, go over the previous one, so you get this concept very, very well. So for a clear understanding as we're progressing, the next episode will be coming very soon. I want to make everything fast as possible so you can get the strategy and we when you put it in practice. I need review. When I get your review, we progress from there. So guys, this is basically what the video for the liquidity. To go over this again, when liquidity is being created in the market, the only people that does that is the banks. And when liquidity is being done in the market, it leaves behind what? It leaves imbalance behind, and also what? Order block behind. So guys, if you like this video, if you like this series, please don't forget to subscribe to my channel. Like this video in order for you to recommend it to other traders that are willing to do what? To learn the smart money concept strategy without paying any dime. I have a Telegram channel I open where I share my trade ideas, not signal but trade idea. and I take how I take trades every day. So if you're willing to be part of my Telegram channel, click the link below this video and you head over to the Telegram channel, where you will learn a lot of things there also. So guys, thank you very, very much. Those that stayed to the end of the video, thumbs up to you. Don't worry, you'll get there. I am also working on myself to get there also. So never give up, and definitely it's going to pay one day. See you guys in the next episode, and remain blessed. Bye for now.